Hello and welcome again to our video learning session. And today we'll be discussing about just-in-time and backflush costing. Now, just-in-time is uh, a system where the company purchase from supplier and it will arrive just in time to be used in the production. Partly assembled units also arrives at the production facility just in time for its completion, and the products are completed just in time to be shipped to customers. So in short, uh, just in time costing system is a system where the company only purchase raw materials when needed so that when it will be delivered and arrives in the production area, that's the only time, or that is the time that it will be used in production. Also, some assembled parts will only be ordered and delivered uh, and directly to our production area just in time it will be needed. So that when we produce our goods, it will be finished and delivered just in time the customer needs it to be delivered as well. So the main purpose of applying just in time is to minimize the cost of handling the raw materials and other inventories such as finished goods and work in process, because whenever we carry some inventories in our companies, we will be incurring cost of handling or carrying these inventories. And if that is the case, uh, we will also be eliminating or minimizing the cost of bookkeeping, because we will not be accounting for the raw materials in our warehouse. We will not be maintaining any stock cards since we don't have any inventory at all in our warehouse. And with that, we must have a very accurate uh, way of recording our accounting informations, because uh, the materials or other parts will only arrive at the time it is needed, and it will be shipped uh, as early as possible to our customers, and therefore we have to be very accurate in all the amounts and quantity that should be recorded. And also, uh, it requires a good relationship with your suppliers, because for you to have equality raw materials, you should have a good relationship with your suppliers, and you should look for supplier who will agree with you that you would only order raw materials from them only when you will need it for production, and only when you will need it for uh, delivery to your customers. And of course, the ultimate uh, advantage of using JIT is the satisfaction of your customer, because you will be delivering the goods that they ordered from you just in time they actually need it. Now, JIT is used in backflush costing, and backflush costing is a method where the company accounts on their inventories backward by calculating the cost of product after they are sold, finished, or shipped to customer, rather than accounting it before and during the production process. So in our previous lesson, we have learned that all cost elements in the production or manufacturing should be accounted for during the production process, so that we will have a unit cost at the end of the production that we can use to uh, say assign a price to our product. But this time it's different. I mean, it's the other way around. We have to finish the goods first, or probably deliver the goods first, and after delivery, that is when we are going to make a journal entry or account for our inventories. So this is like flashing back all the cost that we incurred from the finished good that we delivered or sold to our customers. Okay, so backflash costing is actually does not follow the generally accepted accounting principles because costs are only recognized after the sale. That should have been recorded or recognized during the production process while they were incurred, not after the sale. Okay. Let me give you the comparison of the traditional costing and backflash costing. Uh, Normally in the production, we have to purchase raw materials first. And in traditional costing, we use raw materials account to account for the purchase of the materials, and work in process account when we transfer the raw materials or when the raw materials are being used in the production area. So we have two separate accounts used in traditional costing for raw materials, and that is raw materials and work in process account. Unlike in backflash costing, it combines raw materials and work in process account into one account known as the raw and in process inventory account, or RIP inventory account. The amount of work in process at any particular time will be low, such that it is combined with the raw materials. We will not be maintaining the work in process account in backflash costing. Instead, we will combine work in process and raw materials into one account, and we call it RIP inventory account. Uh, Let us recognize that raw materials and work in process are both in inventoriable account, and combining them is like combining two inventories in one account, and that is RIP inventory account. Now, direct labor is a major cost and account separately in traditional costing. We use to debit payroll and credit all the contributions and accrued payroll. And then when we transfer the uh, payroll to the factory, we debit to work in process account and credit to payroll. Unlike in backflash costing, direct labor is a minor cost. There is no separate account for direct labor, and instead, a temporary account called conversion cost control account will be maintained to record the actual cost of direct labor and factory overhead. The difference between the actual conversion cost and the applied conversion cost is close to cost of goods sold account. So the principles that we have learned in the applications of factory overhead and the actual cost incurred for factory overhead is the same with the conversion cost control. The conversion cost control is the actual cost of direct labor and the actual cost of factory overhead. So there will be a conversion cost applied that will be incurred only upon the recognition of these two elements, the labor and overhead, in the completion of the product. So for factory overhead, we use factory overhead applied to product as they are being produced. Again, we will not be using factory overhead account or applied separately in backflash costing because there will be no more work in process account, and conversion cost, which include both labor and overhead, will be applied when products are completed, not during production, and therefore we will not have work in process account, but only upon completion directly to the finished goods. Or if we will not be using finished goods, directly to the cost of goods sold. So this one is a faster way of accounting for overhead and labor and other, and of course the materials, faster as compared to traditional costing. Now, in backflush costing, we have what we call trigger points. This refers to stages in the cycle, and that is from purchase of raw materials to the sale of the finished goods, at which journal entries are made in the accounting cycle. Meaning, the trigger points will be our hint when are we going to make a journal entries. So for method one, we have three trigger points, and that is upon purchase of raw materials, upon completion of the finished goods, and upon sale of the finished goods. So upon purchase, we will make a journal entry to account for the inventory of the raw materials. And then upon completion, we will do journal entries to account for the inventory of the finished goods. And of course, for the sale of the finished goods for the cost of goods sold. Now, method 2 and 3, they have two trigger points upon purchase and upon sale, or upon completion and upon sale. For method 4, they have one trigger point, and that is upon sale of the finished goods. Again, the trigger points is only a point where we are going to make a journal entry for the recognition of inventory. But that does not necessarily mean that we are limited to make entries to make these numbers of entries uh, as the same number of trigger points. Upon recognition of the inventory on trigger points, we have to make uh, entries, other entries necessarily to account for other actual costs which are actually incurred, and we call it flushing back all the costs that we have incurred during the production process. But this time, instead of making an entry while doing it, we will make an entry after doing it. And that is why we call it flushing back all the cost. So to better understand this backflush costing, let's have some example here. Joven Corporation manufactures a product known as Enhancer version 2. The transactions for the month of January were as follows. We have purchase of raw materials 1 million. This is the actual cost. Labor and wages incurred. This is actual cost also, 300,000. Factory overhead incurred, 400,000. Actual cost also. Units completed is 50,000 units. Units sold is 49,900. So here we understand there is a unsold completed goods, or therefore there are remaining finished goods in our inventory, and that is 100 units. There are no beginning inventories for raw materials, work in process, and finished goods. The standard cost per unit of output is 34.8. From the 34.8, 19.8 is for raw materials, 15 pesos for the conversion cost, and that includes labor and overhead. So 6 pesos is allotted for labor. So therefore, if this is 15 pesos and this is 6 pesos, 9 pesos is for factory overhead. This is standard cost. Therefore, this is the uh, applied cost for the units produced in the production. Okay, let me go through the traditional costing first before we apply the backflush costing. We purchase raw materials at 1 million, so the entry would be debit for raw materials and credit accounts payable. Upon transfer to the production area of the raw materials, the entry will be debit work in process and credit raw materials. 990,000. How did we get 990,000? Let me go back to the previous slide. Uh, the units completed is 50 units, 50,000 units, and therefore the number of units that were produced or were processed during the period is also 50,000 units because there is no beginning inventory of work in process account. Okay, so therefore 50,000 units were processed during the production during the period. So this 50,000 units, 19 pesos and 8 centavos of raw materials were applied to produce this 50,000 units. So therefore 50,000 times 19.8 cents is 990,000 pesos. Okay, payroll is the actual direct labor cost. Debit payroll, credit accrued payroll, 300,000. And then we apply it to the production, debit work in process, credit payroll. And then the actual factory overhead is debit to factory overhead control, actual, credit various account, 400,000. And then the applied factory overhead is debit work in process, credit factory overhead, 450,000. I think you already now understand where we get 50,000, the actual units produced, and the 9 pesos applied factory overhead. As I explained a while ago on the givens of the examples. And then we finished 49,900 units for 49,900 units debit finished goods. I mean 50,000 units debit finished goods 1,740,000 and then credit work in process 1,740,000. That is 50,000 at 34.8 pesos. And then we sold 49,900. The entry will be debit cost of goods sold, credit finished goods. So the difference between the two is the ending inventory of the finished goods. And then upon comparing factory overhead control of 400,000 and the applied factory overhead 450,000, we have an over application of factory overhead and we have to close it to our cost of goods sold. So therefore, debit factory overhead applied, credit cost of goods sold 50,000. Okay, so this is the traditional or the normal way of accounting for the production process. And I think this is clear to you. Now, let's go to backflush costing. Here we will be uh, giving example for a 3 trigger point backflush costing system. Uh, the trigger points would be upon purchase, upon completion, and upon sale. Okay, let me just flash back the previous slide so that you will be reminded of the 3 trigger points: purchase, completion, and sale of finished goods. Okay, upon purchase, instead of debiting raw materials and credit accounts payable, the entry will be debit RIP inventory and credit accounts payable. Okay, raw and in-process inventory, 1 million, credit accounts payable. That's the first trigger point and we made an entry. Okay, and then we produce the product. I mean, we put the raw materials into production. And then the raw materials, I mean, at the end of the process, we will be producing some finished goods. Now, upon completion of the production process, this is another trigger points. We will do an entry on trigger point number 2, which is upon completion of the production. So upon completion, we recognize finished goods, 1,740,000. How did we know it is one? How did we know the completed goods is, or I mean, cost 1,740,000. We have a predetermined standard unit cost of 34.8, and we completed 50,000 units. So therefore, 50,000 times 34.8 is 1,740,000. Okay. And then credit raw and in-process inventory. We only used 50,000 at 9, how much was it? 19.8. Let me just go back. Yes, 19.8 raw materials. 50,000 times 19.8 raw materials, 990,000. And then credit, conversion cost applied, that is 50,000 at 15 pesos, 750,000. Do not mind the red colored entries here. This should have not been entered yet. Again, the trigger points is upon purchase, upon completion. So upon completion, this is our entry. And all the amounts will be, I mean, can be computed because we know the applied or the standard unit cost and the applied rate for each elements for raw and process and the conversion cost, and that is 15 and 19.8. Okay, upon sale, that's another trigger point. We will do an entry, debit cost of goods sold, 1,736,520. How did we get this? That's 49,900 times 34.8, and then credit finished goods. And then after doing these three entries, we will now flashing back the cost. We understand that this conversion cost is only applied, so therefore there is a actual cost that we incurred, and therefore you have to look for the actual conversion cost, and that is 700,000. Based on our data, we actually incurred direct labor cost of 300,000 and factory overhead factory overhead cost of 400,000 for a total of 700,000. So after determining the actual cost, you will make an entry, debit conversion cost control 700, credit accrued payroll of 300, and various account for the overhead of 400,000. This red colored journal entry is the flashing back of the cost after making the journal entries in the trigger points. Okay, so aside from this one, upon comparing control and applied, we have a difference of 50,000. So we have to make another flashback of entry, and that is debit overhead over applied factory overhead of 50,000, and then credit cost of goods sold 50,000. Okay, I just placed it side by side uh, with the corresponding entry using traditional costing method so that you can compare. But actually, it should have been presented as this two red colored entry should have been written after making these three entries in the trigger points. Okay, because these are actually the flashing back of cost. Okay, now let's go to the two trigger points, uh, and that is only upon purchase and sale. So upon purchase, we have an entry of debit raw and in-process inventory 1 million, and then accounts payable 1 million. And then sale. So as you can see, we will not be recognizing the inventory upon completion, but only upon sale. So upon sale, we have a cost of goods sold debit 1,736,000, and that is 49,900 at 34.8. And then, since we have knowledge that the actual finished goods that we produced is 50,000 units and we only sold 49,900, the 100 units multiplied by 34.8 standard unit cost is the finished goods inventory. Okay, let me repeat this one. The actual unit cost, the actual units completed is 50,000. 49,900 is sold, 100 units is finished goods. Using the standard unit cost of 34.8, we will arrive at this amount, 3,480 and 1,736.50. So that will be your debits. Now for the credits, we used up inventory that is 50,000 at 19.8, 990,000. Conversion cost of 50,000 at 15 pesos, that's 750,000. 15 and 19.8 is the same standard unit cost used in computing for your finished goods and cost of goods sold, right? So we understand standard costs are the applied cost. So if this is the applied cost, therefore we have an actual cost, and that is where we are going to make some flashback of costing. So the actual cost is 700,000, debit conversion cost control, credit accrued payroll, and then credit various account 700,000. And then comparing the two, we have an over applied factory overhead. So debit overhead, over applied overhead, and then credit cost of goods sold. So we have two trigger points here, and then we make some flashing of cost, backflashing of cost. Method 2, the trigger points is only at completion and upon sale. Okay, so at this point, upon purchase, we will not be making an entry. We will not be recognizing the raw materials inventory. So only upon completion of the uh, goods being produced. Okay, so upon completion, we understand that 50,000 units were completed. So therefore, 50,000 times 15, no, no, 34.8 is 1,740,000. Okay? But the total amount of raw materials inventory that we received is 1 million, and we have to pay for it. So debit finished goods, 50,000 at 34.8, and then accounts payable is 1 million, and the accounts payable as a corresponding raw materials that should have been 1 million also, but upon inventory, there are some raw materials left in our production area, and that is 100 uh, and that is in amount of 10,000 peso. How did we know that it is 10,000? The accounts payable is actually 1 million. The raw materials used is 50,000 at 19.8, and that is equivalent to 990,000. So therefore, the remaining amount, 10,000, is the raw materials inventory on hand. Okay, so debit raw and in-process inventory of 10,000, debit finished goods of 1,740,000. And then the applied conversion cost is 50,000 at 15, that's 750,000. Okay, so upon completion, you will make an a physical count of your raw materials inventory so that you will know if there are some raw materials still on hand and not all the raw materials were used in the production of the finished goods. Okay, and then upon sale, debit cost of goods sold, and then credit finished goods. And then we do back flushing of cost. This is applied, so therefore there is an actual cost, and then compare the actual on the applied, and then we do closing to cost of goods sold. Now for one trigger point, and that is only upon sale. Upon purchase, upon production, we will not make an entry. We will make an entry only upon sale of the goods that we produce. So upon sale, debit cost of goods sold, that is 49,900 at 34.8, 1,736,520. Since this is only 49,900, there is 100 unsold goods, and that is finished goods. So 100 units times 34.8 is 3,480. And then since we only used 990,000 units of raw materials, there is an ending inventory of raw materials inventory of 10,000. And then we recognize our uh, liability for the raw materials purchased, 1 million, and then the applied conversion cost of 750,000. Okay, and then we flash back our cost. We have actual cost and then the over application of the applied conversion cost. Okay, I hope you have learned something from backflush costing. Again, this is a bit a bit confusing to you. You just have to imagine the production process, uh, making no entry during the production process, and doing the journal entry only on the trigger points. And that is when you work back on the cost that should have been incurred. Thank you very much and have a safe day.